welcome to episode 88 of Mo Money, the investing economics show for millennials by a millennial, where our goal is to educate, entertain, and empower a new generation of investors. I'm, of course, your host, the non-Grammy Award-winning MC Mo. Now let's get to the money. The Tax Cuts and Job Act of 2017, or more simply, Trump's tax cuts, were promised to unleash a massive amount of money into the economy, bring back capital from overseas, and give the economy a huge growth spurt, leading to new jobs, rising wages, new investments, and all these other amazing things. Unfortunately, none of that really came to fruition. Instead of corporations using this freed up capital to reward their workers, they instead have been using this freed up capital to reward shareholders of the company. Which brings us to this week's topic: stock buybacks. Stock buybacks or share repurchase programs, different terms, all referencing the same thing. So when a publicly traded company either steps into the open market or a private agreement, but they agree to purchase back shares of their own stock. If that sounds boring, it's because it is. But never has such a boring stock market transaction caused such fierce debate within both the financial and the political sphere. And by never, I mean like within the past decade, because I'm a millennial and that's about as far back as my never goes. So in this episode, we are going to discuss why companies buy back their stock, why some people are so adamantly against the stock buybacks, and why others support them. From 2005 to 2015, companies in the S&P 500 spent $4 trillion doing buybacks. So let's start with the reasons why a company would choose to do a stock buyback. The first being that unused cash is costly. Since a financial crisis, many companies are choosing to use their excess cash to buy back their stock. A company has a responsibility to its shareholders, and cash that is just sitting around does not give the company any type of return. So instead, companies will use this money to buy back their stock. The more stock that they buy back, the less owners there are outside of the company, which gives them more control over decisions and the direction of the company. The second reason is an undervalued stock. If a company sees their stock price drop to levels they deem irrational or overdone, a company may choose to buy back the stock because they know the price will eventually rise. For instance, many companies bought stock after 9/11 to restore confidence in the market. It was seen as a patriotic gesture. A third reason is for tax efficiency. A company can choose to return cash to shareholders either by dividends or share buybacks. But if they return the cash in the form of dividends, then that payment will be taxed. But if they return the cash in the form of a buyback, then any taxes will be deferred until the shareholders actually sell their shares. And the final reason is that a company may see zero other competitive investments. If a company does not see a reason to raise wages or build a new factory and they see return on money by doing a share buyback, then a 100% makes sense for the company to buy back their shares. Now let's go to the political sphere, where buybacks have become the new poster child for income inequality and Wall Street greed. Elizabeth Warren, Kirsten Gillibrand, Cory Booker, Tammy Baldwin, and even Marco Rubio have all spoke out in the past against corporations engaging in stock buybacks. But an op-ed written for the New York Times a few weeks ago by Bernie Sanders and Chuck Schumer helped push the issue of stock buybacks really into the mainstream discourse. The main gripe of these politicians is that corporations are using excess cash to buy back their shares instead of investing them back in long-term investments for the company and rewarding workers for those profits. 80% of all stocks are owned by the 10% of richest Americans, so these buybacks don't reward average Americans who are living paycheck to paycheck. Sanders and Schumer's op-ed talked about not allowing companies to engage in buybacks unless they paid their workers $15 an hour minimum, ensured 7 days of sick leave, and made sure CEOs' compensation was no more than 150 times median pay of their workers. Because with the presidential elections coming up and no clear favorite for the Democrats, this is a great issue to raise support because they picked a popular enemy, and it's simple enough to explain to the voters. Now to the financial world. We're going to skip what corporations think because obviously they like it and support it. That's why they're doing it. But a sizable part of the financial community of advisors, hedge fund managers, financial media pundits, amongst others, is who cares? But not in a fuck everyone, let Wall Street do what they want, free market rules, but more in a who cares, this is not an issue. Everyone is drawing the wrong conclusion from these stock buybacks. They do not view stock buybacks as companies throwing money away. When a company buys their company's shares, they give someone else the cash in exchange. So that cash is now no longer sitting in Apple's bank account. It's in the hands of an investor who sold their shares. That investor can now take that money and invest it in another company who may need that cash to build a new factory or hire workers, invest in R&D, stuff like that. The argument is share buybacks are another way the market makes sure capital or cash is not sitting idle and is flowing to the places where it can create the most value within the economy. So these billion-dollar buybacks should be viewed as trillions of dollars flowing back into the capital markets for reinvestment in companies with more growth potential. There's been great rebukes against claims that buybacks are the main contributor for the rise in the stock market, the rise in income inequality, and that buybacks come at the expense of profitable long-term investments. Bottom line, there are some problems with the stock buyback programs. Up until 1981, stock buybacks were considered market manipulation by the SEC and were illegal. One issue is that it can be used in the short term to reward executives who have performance-based pay. Another issue is a lot of companies have been buying back their shares with money that comes from issuing debt, which causes the company to become increasingly leveraged. Alright, now that I've done the unbiased presentation, here is my opinion, for what it's worth. There is a problem with income inequality in our country, but scapegoating share buybacks is not going to solve it. I don't believe any of the previously mentioned politicians know what they're talking about when it comes to companies' share buyback programs. There are issues and nuanced discussions about the economy, the financial markets, and government policy consequences that need to be had. But turning buybacks into the boogeyman and then using them to force other responsibilities on companies is a terrible idea. At the moment, Schumer and Sanders are supposedly creating a piece of legislation along the lines of their op-ed, so we will wait for that, and when it arrives, you know I'll be making an episode about it. Until then, thank you so much for watching another episode. You can find new and classic episodes of Mo Money right here on YouTube. For now, don't forget to like, comment, subscribe, share, follow me on Twitter, follow me on Instagram, like me on Facebook.
Mo Money, signing out.